for your transaction fees in that currency. Since Cello is a project that focuses on emerging market payments or frontier market payments, this might be a very useful feature there. And block headers, especially the size of the block headers, is optimized for fast mobile phone synchronization. I promised to talk about stablecoins, and probably everyone here in the room is aware why there's a need for a stablecoin and why a stablecoin has value for user-to-user transactions. Here is a special year in crypto price history, the prices of different cryptocurrencies in the year of 2018. And another decentralized stablecoin on the Ethereum platform, DAI. And as you can see, DAI was more or less stable in that time, a very low volatility, especially very low downside volatility, while other currencies, even those currencies that back DAI, lost a lot of value. For example, ETH in 2018, I think almost lost 80% or maybe even more than 80% of its value. So there's a need and there's a use for stablecoins for transactions. There are different types of stablecoins, and I want to briefly talk about those different types. There's the fiat or commodity collateralized stablecoins, which would be IOUs and have as a collateral, for example, the fiat currency they trying to track in terms of values. In terms of value, there are crypto collateralized stablecoins, like for example DAI, where the collateral is a cryptocurrency, and there are algorithmic or seniorage style stablecoins that in their functioning or in the economics around that are basically mimicking a systematic central bank, basically, or an algorithmic central bank. And probably all of you also know examples for the different types of stablecoins out there. I think for fiat collateralized stablecoins, there's one popular example is Tether. Tether is basically based on the promise that there is or might be some collateral somewhere in a bank. And you can either believe that or not. However, the short history of prices we have on Tether shows that it is relatively stable, and a lot of the stability is derived from this speculation around Tether. Is there actually a collateral in place? Could a bank run be happening, and people all want that Tether back at the same time? And if this fear comes up, then Tether can depeg, maybe briefly, and then there's again a lot of speculation. Maybe it won't come to a bank run, or maybe the collateral is actually in place. And then in repegs and around this speculation around the one Tether trading at a US dollar, there's a lot of trading volume, and so far the peg holds. There are other examples for fiat or commodity-backed stablecoins. There are also stablecoins that have different types of commodities as a collateral. So there are examples that hold gold in collateral, so physical gold in a vault somewhere, which then also has to be basically audited that the gold is actually in place. There are examples for stablecoins that hold diamonds in a collateral, since they are easy basically to store and relatively small. And there are also stablecoins that hold different types of other precious metals in collateral. So these are typical fiat or commodity collateralized stablecoins. I think the advantage is that there's a very direct link to the value they are trying to track. So if a stablecoin holds US dollars in their collateral, there's a very direct link if you are always able to exchange your stablecoin for that dollar in collateral, and therefore this link to the value they're trying to track is very direct. This is a big advantage. The big disadvantage is also, as you know, around, for example, Tether. This is a more centralized way, and you actually have to believe that the collateral is sitting somewhere. In the example of Tether, I think there are stories that this might be sitting with a bank somewhere in Costa Rica. This bank then has a certain counterparty risk. This counterparty risk can actually be priced. So when you go to a bank and take out a loan or a credit, you can actually look at the rating of that bank, and this rating then should also reflect basically the riskiness of that bank to default. So if, for example, that bank in Costa Rica might default with a certain probability, then credit at this bank should have a certain price that reflects this probability. And therefore, in the long run, you would expect that Tether trades at a discount to $1 that reflects basically the probability of default and the probability that the collateral is actually in place. Second example or second type of stablecoin I included here are crypto collateralized stablecoins. Probably everyone here knows the most prominent example for this, which is DAI. There are different types of DAI, single collateral DAI that holds ETH in collateral, and multi-collateral DAI that holds different other liquid cryptocurrencies in collateral, and you basically can create or mint DAI into existence by closing a CDP, which is a collateralized debt position, and against this CDP you can basically issue DAI stablecoin to the market by locking up your collateral. And then the last example of stablecoins are seniority style or algorithmic stablecoins. One first example in the market of these type of stablecoins is, for example, the Basecoin. Basecoin was a type of stablecoin that also basically try to adjust the supply of stablecoin in the market to demand of people that want to do transactions with this stablecoin. And to adjust supply and match it to demand, there are certain types of expansions and contractions. Big problem with Basecoin was that it's actually not easy to predict how much you have to expand or contract if the price deviates from 1. So if you're tracking, for example, the US dollar and the stablecoin trades at $1.10, you would need to expand your supply of stablecoin to match the increased demand that led to a rising price in stablecoin. And this prediction, how much you actually have to expand or contract, is not easy to predict, since you have to make an assumption around the demand function. I think this and several other problems around the Basecoin design then led to the shutdown of the project, I think sometime last year, where the Basis team decided to give back the funding they received for developing that stablecoin. I think another problem around the Basecoin design was that they, for contractions in supply of stablecoin out there, wanted to do a certain type of security. They want to issue a bond, which lets you or allows you to buy back stablecoin on the market. When they designed it and said this is basically a bond, they asked the SEC if it can certify or underwrite that this bond is not actually a bond and not actually a security, something that the SEC typically not does, and therefore I think another problem around the design of Basecoin. There are other examples out there around algorithmic stablecoins. I mentioned the project I'm working on, Cello. It's another type of algorithmic stablecoin. I'll talk a bit about the design on Cello in a minute. But in general, a bit later in my talk today, I want to basically point you to some I would say, empirical facts you could have a look at when judging on the stability features of a certain algorithmic stablecoin design, so that the talk is a bit more general than just about Celo, which I obviously like in terms of design. I talked about these different features already. So you have, again, the different types of stablecoins that are in the market. So there are the fiat collateralized stablecoins, the crypto collateralized stablecoins, and the seigniorage style or algorithmic stablecoins. I also mentioned the example of Tether, which is a fiat collateral stablecoin in the first row. The governance feature of Tether is basically that this is a more centralized type of stablecoin, which has a regulated collateral in place, which is off-chain. I mentioned the problems around this off-chain collateral that basically is built on trust that this collateral is actually sitting somewhere. You also have a counterparty risk of the entity that holds this collateral. Another item I could maybe point out is that with off-chain collateral, you also have the problem that your stablecoin could be traded 24/7 as any other cryptocurrency out there. Your collateral basically cannot be traded 24/7. So you have certain opening hours of the market. In the design, for example, Libra currently envisions you have a similar feature. If Libra actually holds a portfolio of different risky asset classes like government bonds and corporate bonds and equities, then there needs to be a manager that basically manages all the risks associated with these types of asset classes. So for example, for the government bonds they want to hold in the portfolio, you have a duration risk, you have an interest rate risk. You need to roll over the security at the time of their maturity, and you need to do that when the market is basically open, which means then that your collateral cannot basically match your underlying over the weekend, for example, or at night. I also mentioned Celo. So basically, Celo is a hybrid between a crypto collateralized stablecoin and this seigniorage style or algorithmic type of stablecoin. So there is a feature or a mechanism on Celo that always adjusts the supply of stablecoin to the current demand in the market, and therefore there are expansions and contractions happening. And typically with these types of stablecoins, expansions are relatively easy. You can just mint stablecoin and sell it against something to the market. Where it gets tricky are contractions. Contractions mean that you want to reduce the supply of stablecoin in the market to again bring back the price to 1. And when you do that, you need to somehow buy back basically your outstanding stablecoin, and therefore you need some collateral out there that is able to buy back your stablecoin. One important part of designing the Celo stability protocol was that the collateral should only be on-chain, so it should be tradable 24/7, it should be liquid, and it should be basically for everyone who looks at the blockchain, everyone should be able to verify that the collateral is actually in place, something we cannot do when the collateral sits with a bank. For example, then verification of the collateral, for example, is more difficult. When you think about these algorithmic stablecoins, it's always the story basically that you want to match with the supply of your stablecoin, the current demand in the market, and that current demand is fluctuating. And here in that example, in the perfect peg case, which is where the green and the blue line intercept, you can see that there's a supply of 20 million stablecoin in the market, And there's the blue line is your demand, and blue and green line actually meet at a price of $1. So in this case, there's a perfect peg for the stablecoin. Everything is I would say going good for that stablecoin since it holds its price peg. If, for example, the supply in this example here would only be 19 million, but the demand is still 20 million, we would have more demand than supply in the market, and the price would then depeg. The amount of depeg depends basically on the demand function, so how, for example, steep this blue line in this example here is, then determines how much the price would depeg of the stablecoin. Maybe I start with this slide. Big problem is that the demand in the market is basically random. So the demand is fluctuating all the time. It depends on how many people want to do transactions with that stablecoin, how many people want to hold the stablecoin, and therefore the demand fluctuates all the time. And therefore, basically matching supply and demand at every point in time is a tricky thing. And when we talk about how you could simulate and think about how demand behaves in future, when you want to issue a stablecoin, it's even more tricky because you have to simulate somehow this random demand that your stablecoin basically hits. And this is tricky. So what you could do is basically you could try, when designing a stablecoin, you could try to mimic a fiat-backed stablecoin. Because in the end, as I said, the big advantage of a fiat-backed stablecoin is that it's very directly linked to the underlying that it's trying to track. So if you're, for example, issuing a stablecoin that is tracking the US dollar, and you're offering a facility that always allows you to exchange one stablecoin for one US dollar, then in times where this stablecoin at a centralized market like Coinbase or Binance or something else would depeg, then somebody could either buy it or sell it at that different price and then actually go to the stablecoin issuer and exchange it for a US dollar. So for example, if you could buy a stablecoin at Coinbase for 95 cents, you can buy up every tether at Coinbase for 95 cents and then go to Tether and say, hey, you actually have collateral in place, give me $1 back. And then you earn basically 5 cents on every transaction until the price is back at 1. And you actually buying up every stablecoin that trades below the dollar then drives up the price. When we designed Zello, we wanted to design something very similar, something which offers you basically that facility that you can always approach a protocol on chain and say, here, I want to exchange the stablecoin for the value of the underlying, however, with a crypto-only backing of that stablecoin. And therefore, there's basically a on-chain mechanism, which is a bit similar like a Uniswap exchange, which is an on-chain market maker that always allows you to transact with your blockchain. And when you approach basically the Zello on-chain market maker, you can always say, I want to, for example, I want to sell one Zello dollar for $1 US worth of collateral, or I want to buy one Zello dollar for $1 US worth of collateral. And this collateral, as I said, is on-chain collateral. So in that reserve, there's a governance token, which is called Zello Gold. And this governance token is basically similar to ETH on the Ethereum blockchain. So it's basically your utility token. And you always have that standing facility that you are able to trade one Zello dollar for $1 US worth of Zello Gold. And therefore, when at centralized exchanges, the Zello dollar is trading below $1, you can basically buy it at Coinbase and then sell it for this on-chain exchange, or at this on-chain exchange, and then you get Zello Gold in the value of $1 US, and then you go back to Coinbase and get your dollar back. And the whole time where cello dollar is basically trading below the dollar, you keep on doing that trade and therefore driving up the price. So it's, I would say, a similar design. You try to match supply and demand with an on-chain exchange without having a non-crypto collateral. And about algorithmic stablecoins and how you could actually analyze the stability of a stablecoin with this design is, as I said, the demand is random. So if you want to simulate or maybe empirically look at how could the demand be for your stablecoin, you could look at historical data, for example. Since your stablecoin is not live and not traded yet, it's very difficult to get historical data. You could then look at historical data of other stablecoins, like, for example, Tether. But the big problem with that is you only have a very limited amount of data on demand for Tether, and maybe the first like 5 or 8 years in that industry or in that type of asset class is a very limited data set to actually make some inferences or some statements around behavior of demand for stablecoins. Since, yeah, I mean, it's a new type of asset class, and maybe in the first years there's some like bubbles. People want a lot of it, people want to dump a lot of it. So it's maybe not the typical market behavior you would expect going forward. Therefore, another thing you could do to analyze a stablecoin and analyze the stability of a stablecoin is basically simulate these paths here. And this is what we did. In our stability analysis. The old version of it you can find on our website, the new, or on the Cello website. The new version of it you can find, I hope, this week on the Cello website. And when we simulated different paths of demand, we used a stochastic process. As I said, we don't know how demand will evolve in future, so we use some statistical process that can simulate this demand. What we did in the first version is basically we used a geometric Brownian motion, which is a certain type of stochastic process that you could use for doing that, for simulating demand. The geometric Brownian motion is basically a process we used here, which gave us a demand in amount of stablecoin at the price of $1 at every point in time, at every maybe hour or day or second, however the frequency is you want to simulate over the next 30 years. And then you can, when you use this process, you should specify 2 parameters to simulate the stablecoin. One parameter is basically your expectation, how it will behave in future, and this is the mu here, and you could, for example, simulate that the mu or the expectation is basically on average the demand will grow by 0. And then you simulate some, or you specify some volatility around that mu, which you could take from his distribution of other asset classes or from a distribution from stablecoins out there, how the volatility could look like. And what this process then gives you is basically around the 0, a lot of different set of paths that stand for future demand for stablecoin. And what you can already see here is a feature of the geometric Brownian motion, which is, I think, more known in research around other asset classes where this process is used more often. So, for example, when you do research on equities, you also use this process. And since, for example, equities similar to cryptocurrencies could behave different than this process might suggest, you can even add jumps. You could add market-wide jumps that something like a coronavirus is hitting the market and everyone goes crazy, and then the stock of hand sanitizer goes up and all the other stocks go down. So you could simulate that. And build it in, and what you then have is in finance literature called the Merton model, which is basically the geometric Brownian motion, and you added some jumps to that geometric Brownian motion that could be asset specific or market wide. And what you can see here is a very specific problem of that geometric Brownian motion, because when you simulate over 30 years, in the end, you want to have a lot of different random paths, and you want to have an expectation value, a mean of 0. And when you then have 2 paths in your set of simulations that completely go crazy and say, okay, the demand in 30 years is 1 trillion stablecoin, then all the other paths should make up for it, should make up for basically for it, since you want to have an expectational value of 0. And therefore, all the other paths go to 0, since 2 paths go crazy. And this is a very specific feature which brings a lot of, I would say, difficulties when you actually want to simulate future demand. I also added the geometric bound in motion with different parameters. So here you can see a set of scenarios with a mu of 0.5 and a sigma of 0.75. And then what you can see over 30 years is that all these paths at some point in time go to infinity, because you simulate for a very long time, you have an expectation that this is growing, and therefore at some point in time one of these paths starts to go crazy. And when we go back to that example, one observation which leads to this behavior is basically on the downside, your demand for stablecoin is capped, because the lowest demand you can have for stablecoin is basically 0. Nobody wants that stablecoin. On the upside, it's not capped. And therefore, you have this feature that some basically go crazy and the rest has to go to 0 then, because you can't make up for it that like some of these paths can go to minus crazy, which is not possible when you want to simulate demand. And therefore, in the end, what we did, and I just want to point you to these different types of processes to simulate the demand for cello dollars, is we actually use a process that has a mean reverting feature. Therefore, even if some paths go too crazy at some points in time, they come back to normal in other points in time. And therefore, this process, which is called geometric Ornstein-Uhlenbeck process, is a different stochastic process you could use for simulating demand for stablecoin, which has nicer features than the geometric Brownian motion for these types of empirical analysis. What we then also did is we added jumps to the simulation. So it could be then at a certain day, someone wants to attack your stablecoin and tries to sell every stablecoin short. There's George Soros in the market who wants to launch a Soros type of attack to your stablecoin. And other points in time, there could be positive jumps. So it could be that you have a worldwide organization that wants to use that stablecoin for remittances, for example, and you have an upward jump in demand for stablecoins since they use it maybe for charity payments, and they send a lot of payments with that stablecoin, and then your demand jumps up on a certain date, and this is something you cannot capture with this geometric Ornstein-Uhlenbeck process, and therefore we added again these jumps. And these jumps, when you do a simulation of different stablecoins, for example, can then be either asset-specific, so idiosyncratic jumps of that certain stablecoin, or they can be basically market-wide jumps, so basically the whole crypto market jumps to like a lower value because, I don't know, a country bans crypto or everyone now wants to use crypto and therefore it jumps. And what you can see here in the picture is basically the difference between the geometric Ornstein-Uhlenbeck process paths, and you can here only see the percentiles, which are the dotted lines, and then these solid lines are basically the differences to that percentiles that come out of that geometric Ornstein-Uhlenbeck process when you add these jumps to your analysis. And as you can see, there's a difference that is actually of value basically, and therefore you should maybe consider that when you do a analysis of stablecoins. Actually need to drink my coffee. So to like sum up a bit more general the points I wanted to make around analysis of different types of stablecoins is basically when you look at an analysis of the stability of a stablecoin, you should first make the difference between, is it a scenario analysis? Do you want to basically learn something about the behavior of stablecoin in different, for example, market environments, or is it a forecast? And that forecast can be also done in a different way. You can just say, okay, I'm a marketing person for Tether, and in 1 year we have 10 billion Tether in the market, and this would rather be a forecast. If you want to do a scenario analysis, you can do it either by doing an empirical or a theoretical study. When you do a theoretical study, it's more around, you try to model in closed form solutions, basically a model that matches the supply of stablecoin to demand of that algorithmic stablecoin. If you want to do an empirical study, you need some type of scenarios, some type of demand behavior in future. You can basically get these different demand paths in future by doing either a historical or a simulated study. I briefly talked about that. So if you do basically a historical study, you can basically bootstrap the behavior of demand in the market for other stablecoins out there, the demand for Tether, the demand for Terra, and so on. So you can basically use different data sets from different cryptocurrencies out there, and can maybe even bootstrap them and generate more scenarios by, for example, looking at them in different ways. But you can also simulate the demand, and when you do that, you need to have a certain type of scenario generator. When working on Cello, we used these two, the geometric Brownian motion and the Ornstein-Uhlenbeck process. We found that the geometric Brownian motion has a very difficult feature to be used in the analysis of stablecoins, and also maybe in the analysis of other assets out there. And therefore, in the end, we decided for the Ornstein-Uhlenbeck process. And as I said, if you expect a very normal behavior of your market in future, you don't have any big outliers, heavy tails or anything, then this geometric Ornstein-Uhlenbeck process is fully fine to do your analysis. If you actually expect that there can be like crazy outliers and there can be heavy tails in the distribution of demand for your stablecoin, you should maybe look at features, how you can basically bring these heavy tails into your simulation, and then adding jumps, for example, could be one way you could do, because basically jumps then are outliers, which are basically extreme demand shifts on a certain day, which wouldn't be predicted by, for example, a normal distribution. So this is how you could think about analyzing a stablecoin. If you're very interested in more details, this is work we've done while working on Cello, and we published a paper on this on the Cello webpage. If you want to have a look at it, I think this week we will update the paper version, which then also includes the Ornstein-Uhlenbeck process and also the heavy tails and so on. So if you want to download it, maybe wait 3 days or something. I hope I can upload it by then. A few more words around Cello when I have this crowd here. If you're interested in Cello, we actually just finished our incentivized testnet competition. So as I said, Cello is a proof-of-stake network, and you could basically try out that network by staking and validating in what we called the Great Cello Stake-Off. This basically staking competition now ended, and we're launching the Cello mainnet, including the governance token Cello Gold and the first stablecoin on Cello, the Cello Dollar, around April. So if you have an idea on a project together with Cello, you could basically apply for a fellowship. You could run a node, you could run a validator on mainnet. You actually can contribute to the code base, so everything is basically open source, and you can find a GitHub link here. You can also look at the many open positions at the core team working on Cello, and Also, there's a Medium link down here, which you can also find when going on the Celo webpage or the Celo blog. We launched Celo Camp, which is basically a boot camp that shows you on how you can contribute to the Celo code base. So this is a cooperation of C Labs, the team working on Celo and Upright. So it's basically Celo Camp, not Libra Camp, so the cooler and permissionless version of it. And then there's also an ecosystem fund. So if you have a great idea for a project that basically contributes to the decentralized finance system that we hope emerges also on Celo, then you can pitch that idea to the ecosystem fund. The ecosystem fund is run by Polychain Capital, and you can basically pitch your idea. And then one last thing, as I said, we are launching the mainnet soon. Before our mainnet launch, we want to distribute the governance token more. For a proof of stake network, it's important to have a very diversified holder base of governance token holders. The first distribution will be done via CoinList. So this is targeted at non-US purchasers only. So this is if you're from the US or live in the US, this is nothing for you, but for everyone else can basically participate in that auction and buy a share of the governance token. If there are any questions around that or around stablecoins or around stability, I think I have 10 more minutes or 5 more minutes, so please go ahead. Otherwise, I'm also around at the conference for the next 2 days, so please approach me. I'm always happy to talk about economics around stablecoins. So yeah, thank you.
I don't know too much about Celo, but I assume that it works in a similar way as Ethereum, that it's public, permissionless network. So is the increasing or shrinking supply mechanism is like a smart contract or something, so it's kind of deterministic, right? And how does this fact that it's deterministic and possible gameable by an attacker, so how does it impact its stability? And also, like, we had some ideas to create something similar on Ethereum called Metacoin. Mm-hmm. I don't know if you heard about it. And they used PID regulator for this. I mean, this was the idea. So what do you think about these problems?
So yeah, you're fully right. This is basically all based on smart contracts. Celo as a blockchain is a fork of the Ethereum blockchain. So the stability protocol is implemented via smart contracts, so everything is deterministic. Therefore, basically, the only random part in this analysis is basically the demand, and therefore we use this stochastic process to simulate the demand. Because then all the rest that follows, how the protocol reacts to changing demand, is deterministic. And in the end, we try to solve the problem of basically a deterministic and random quantities hitting each other via a marketplace. And this is basically this on-chain exchange. This on-chain exchange is basically this facility that always allows you to exchange stablecoin for governance token back and forth. What then can actually be happening is that market participants would try to basically trick this mechanism and trade a lot with this mechanism. And this is very borrowed from this Uniswap idea of a decentralized market maker that basically on-chain adjusts prices for varying basically trading volumes, trading with this mechanism. And you could imagine this Uniswap type of exchange like 2 sets of tanks. So basically, if the tank of, for example, governance token or utility token on chain gets depleted because a lot of people want to buy this utility token on chain, then this mechanism, this Uniswap market maker, adjusts the price, and therefore it's basically we try to mimic a market behavior with this mechanism.
So I'm curious, why you want to build a new blockchain instead of Ethereum? Just build it on Ethereum. Right.
So I think there are different reasons for that. One reason is basically the focus on the ultralight client, the focus on basically this mobile-first blockchain in terms of how you can actually interact with the blockchain. So everything we build is basically for frontier markets where people don't have access to stable currencies or a traditional banking system, and have in many of the times access to ultra-light clients like mobile phones, like very cheap Android phones, for example. And therefore, a blockchain needs to be very, I would say, efficient in terms of data, in terms for each transaction. It also needs to be very efficient in terms of energy it uses for each transaction, and therefore, basically, we used on this blockchain certain technology like CK snarks to reduce block headers for transactions, to have like very efficient transactions that basically cater the need of these ultralight clients. This is one of the reasons. It's also one or another reason then is also in terms of basically the stability protocol. Especially in these markets, it's very important that you are able to pay for your transactions in the same currency as you do the transaction. So if you, for example, pay in Cello dollar, you should also have the option to pay for your transaction fee in Cello dollar. And therefore, this is also a feature of this blockchain that is very geared towards that use case.
And then the mobile phone PKI series is available on the chain?
So there's basically the PKI is basically there's a mapping of on the chain of hashes of phone numbers to your public key. Therefore, you can basically find other users in that system by knowing their phone number.
But this mapping is public.
So it's basically the hash mapping is public. So the phone number itself is not public.
Well, thank you.
Thank you very much. And yeah, feel free to come by the next days. Always happy to talk about that. Thank you.